Hello, and welcome back to Get to Know Hedge Fund Investing with Carl, the Carl Investment Platform. I'm Jamie Eppenberg. We have been talking about the types of investors that we see using hedge funds, both historically and then now that hedge funds are available to those accredited retail investors. And this is really what we're seeing on the Carl platform, the types of investors we're getting. We've been through the shiny ball investors and we've been through diversification as the largest pool of investors. They're looking for more opportunities that will behave on their own, regardless of what market we're in. How can they grow more money and make sure that they have more capital working regardless of any market? Largest buckets. We do have some other types of investors, though, that are worth mentioning. And one of those are the savings and bond investors. So this may even be the close near retirement investors. So these investors are very much more focused on the risk profile of investments than the targeted returns. It's not that returns are not important to them. I wouldn't want to say that, particularly if you're one of these investors. It's just that the risk profile, they don't want, there's a reason they're looking at hedge funds, which is they could just put their money in the market, yes, but they may have to incur a 20 or 30% loss on any given day. And it's difficult to predict what that day is, right? When the market goes down, it's a tough day. And the recovery periods can be long. And so these investors are saying, I have money I may need some time, or I have money I'm going to need soon in the retirement case. And I don't have the time for that recovery right now. And so they are very much looking at, and I've mentioned these before, the annualized volatility, the worst drawdown, the recovery periods, and the largest monthly losses. And they're looking at things like, what's my worst drawdown? What's my largest monthly loss? How long does it take to recover from these things? And, balancing these out. Just so you know, when these investors are looking at the risk profile and they have less the targeted returns are not as critical to be as high. We do have funds that fit this category for them. So you're going to see funds where you're questioning, like, do the fees make sense on this fund? It's not quite, it's not quite reaching 15% every year or more. Why is this hedge fund on the platform? This is why, because you look at the risk profile and it may make more sense that the investors would say, oh, given this risk profile with these types of historical gains, this can make sense to these more risk sensitive investors. And I'll try to point that out as we go through the investments. While a lot of different funds do fit this category for investors because it depends on how risk sensitive they are. So they'll look at each fund a little bit differently depending on that risk sensitivity. The other type to talk about are they're looking for what we would call portfolio insurance for that downturn. And these are true tail hedge, like I want something going up in my portfolio when the market is going way down. And that's a good utility to have in a portfolio. There's just a couple of things we want to talk about that when we go through the individual funds that fit this category. This is a big difference between mutual funds and hedge funds. Is mutual funds don't short. Hedge funds can build in where they're essentially shorting the market. Now, some of them are built entirely as tail hedge, and I'll talk about which ones those are when we go through individual funds, but they will not perform in a flat or bull in a big gaining market. They don't have a strategic, trading opportunity in those types of markets. They are specifically looking for the downturn, and then they outperform significantly. There are those. And then there are also long short funds, which they will take long position. They will look for the gains in the market, and they'll perform in flat or bull markets, or at least target to perform in flat and bull markets. And have historically performed. And then you'll also see that some of them that do that also have a hedge built in, and they'll detect by their many systems when the market's going down, and then you'll see them suddenly perform in that capacity. And you can see this when you compare them to indices, common indexes. They will go up as you'll see a market go down. So you have the ones that are true tail hedgers, and you have the long shorts that can give you a hedge, but still keep money working in other types of markets. That's it for today. I think those are the basics of the types of investors we see, and I might mention one or two in the next session, but hopefully we'll move on to the individual funds. We'll talk to you soon.